All right, let's talk about Bellring Brands. This company is an absolute juggernaut in the nutrition world. You know, the name behind some of the biggest protein shakes and bars you see everywhere. They seemed completely unstoppable. Until, well, they weren't.
First, let's just appreciate how well they were doing. The company was on an absolute tear, posting a massive 20% revenue growth for the fiscal year. I mean, they were just consistently crushing their own goals. By every metric, they look like a picture of perfect health and total market dominance.
And then, this happened. In just one day, the stock price absolutely cratered. It collapsed by nearly a third. It was a complete bloodbath for investors, and it seemed to come out of absolutely nowhere.
So, that leads us to the big question we're tackling today. How does a company that is growing that fast, that seems to be doing everything right, suddenly just fall off a cliff? To figure this out, we've really got to dig into the paradox at the very heart of Bellring Brands.
So let's start peeling back the layers on this thing. How does that kind of incredible success hide such a shocking and frankly dangerous vulnerability?
To really get why they collapsed, you first have to understand why they were so successful. And the key to their dominance was this brilliant and, deceptively simple idea they called the barbell strategy.
Okay, so picture a barbell. On one end, you've got premier protein. This is all about huge, mainstream appeal. It's about massive scale, and the message is simple: protein for everyone. But on the other end, you have Dymatize. That's a high-performance, high-margin brand built for the serious, hardcore athlete who cares about results above everything else.
And boy, did this strategy work. Premier Protein was for everybody: the busy professional who needed a quick meal replacement, families trying to be a little healthier. Meanwhile, Dymatize was building this incredible street cred with elite athletes who needed pure ingredients for muscle recovery. They were just perfectly capturing both ends of the market. It was genius.
And just look at how dominant Premier Protein became. It captured a staggering 30% of the entire US market for ready-to-drink shakes. 30%! That is just an incredible number. Its growth was absolutely explosive, no question. It was the engine driving the whole company forward.
So the brands were amazing, but the strategy they used to actually make these products, well, that was a real double-edged sword. On the surface, their asset-light model, which basically means outsourcing all their production, seemed like a total stroke of genius.
I mean, the logic is really simple and powerful, right? If you don't own your own factories, you avoid these huge upfront costs. It lets you be super flexible, you can scale up or down really fast, and you can pour all your money and energy into what you're actually good at: building and marketing these incredible brands.
But here's the catch, and it is a huge one. That same smart, capital-efficient strategy was a trap. By giving up direct control of their manufacturing, they basically baked a deep, hidden vulnerability right into their business model. And that vulnerability would, eventually, bring the whole company to its knees.
And that vulnerability, well, it didn't stay hidden for long. In 2025, it triggered a crisis that completely snapped their entire system.
Now, before we get into the timeline of what happened, you have to understand this one key concept. It's called the bullwhip effect. So imagine cracking a whip. A tiny flick of your wrist creates this huge, massive wave at the end. The same thing happens in supply chains. A tiny little change in what you and I buy at the store can create these massive, completely distorted orders all the way up the chain. And for a company like Bellring, with no direct control over its factories, this effect is incredibly dangerous. It creates a giant gap between what they think is selling and what's actually flying off the shelves.
And that is exactly what went down. In May of 2025, the company put out this kind of vague warning about headwinds, saying retailers were cutting back. The stock dropped 18%. But by August, the whole devastating picture came into focus. Net income had plummeted by over 71%. The retailers had slammed on the brakes, that bullwhip cracked, and the whole system just imploded. The stock collapsed, and suddenly the company was facing a securities fraud investigation.
So how in the world do you recover from a catastrophe like that? The brands are still strong, but the way they operate is fundamentally broken. Let's take a look at what Bellring is doing now to see if it can actually fix this fatal flaw.
Okay, so the company's response was pretty decisive. They immediately started building a more resilient supply chain. And in a pretty big reversal of their entire strategy, they actually partnered with their former parent company, Post, to build a dedicated factory. It was a clear admission that the pure asset-light model was just way too risky. They needed more control, more stability to protect their crown jewels.
And really, this whole situation is summed up perfectly right here.
On one side, you've got these incredible strengths, dominant brands, strong financials, but on the other, this huge glaring weakness in their supply chain. The opportunities for them to innovate and expand are massive, for sure, but so are the threats from fierce competition and, constantly changing consumer tastes. It's a powerhouse, but it was built on a really fragile foundation.
And that kind of leaves us with this final thought. It looks like Bellring is fixing the operational problem, right? They're taking back control to build a stronger company. But in a world that moves at the speed of social media, where health and wellness trends can change overnight, maybe the bullwhip effect was never the real long-term danger. Perhaps the greatest threat is that while they were busy fixing the factory, their customer just moved on to the next big thing.